All right, so we've got something interesting this time. We've got case three, which is going to be on audit risk. And so a little bit of background on this. This came from a research project that I had done where I was trying to actually characterize the nature of audit risk. And audit risk conceptually is actually pretty straightforward. We understand the audit risk equation, we understand the components. But how to practically apply audit risk can be a little bit of a challenge sometimes. And this is kind of an effort to try to see if we can do a better job of that. So the foundation of this kind of starts with the conceptual application of audit risk, which is one of the first few questions that gave you. So I had you read some items, the case, and then also understand a little bit about Wirecard. Now you may ask, why is Wirecard relevant here? And the answer is this was actually the motivation for the original case. The case sparked intuition power, which was actually done with me, a colleague of mine, Catherine Ingot, and then a former student, Mitchell Heber. And he was based on the capstone paper he wrote on the Wirecard fraud. And so we decided to utilize this as a framework for how to actually analyze the audit risk model. So the question number three says, what are the photo components of the audit risk model? And briefly define each component and provide a practical example of each component. So what I'd like to do is I'd like to go through the four components. Now remember, auto risk equation, it's actually given in the case that I have provided to you, sparked intuition power. And you see audit risk is risk and material misstatement times detection risk, where risk and material misstatement is a function of inherent risk and control risk. And again, that was something you learned back in undergraduate auditing. It shouldn't be too difficult to get through. But let's go ahead and talk a little bit about each of the components, just as a refresher, a reminder for these items. So audit risk is the risk that the auditor expresses an inappropriate audit opinion when financial statements are materially misstated. If you recall, I characterized this as type 2 risk. From a scientific perspective, type 1 risk is saying that there is no problem, or sorry, there's a problem when in fact there's no problem. Whereas type 2 risk is saying there is no problem when in fact there is an issue. In this case, the financial statements are materially misstated, but we as auditors are saying they're fine. That is a big no-no and what we're generally focused on when we talk about audit risk. It's not to say type 1 risk is not an issue, but it's generally less of an issue than type 2 risk, type 2 error. So audit risk is basically that type 2 error that we would characterize as saying that we think everything is fine when everything is not fine. So an example of this would be, I kind of written down as an example here, although the audit engagement team for Go Corporation was not able to obtain sufficient appropriate evidence to justify its conclusions, the auditor issued an unqualified audit opinion. So just basically as it sounds, the unqualified opinion was rendered when in fact they should not have been able to render a unqualified opinion. In this particular scenario, there was not sufficient appropriate audit evidence, so there was not a basis, a proper basis for the opinion being rendered. All right. So moving on to the second component, that's first component of risk and material misstatement. That's what we call inherent risk. And the way that I characterize inherent risks are the fundamental risks related to an entity's operations. By going into business, an organization is exposing themselves to certain risks in their entity and their environment. So this is something that we have to be aware of because that kind of leads into the risk and material misstatement in the second part. So an example of this would be Halter Technologies operating in an industry that is highly competitive and subject to rapid change. By being in that industry, they are exposing themselves to the risks of being within that industry. So that's going to be something we characterize as an inherent risk in that regard. Now, we know that inherent risks need to be identified because the client needs to be able to adopt appropriate controls in response to risks. So the way that I've always characterized controls is they're just responses to risks. That being said, there are still risks that we can identify outside of the scope of inherent risks. These are going to be the control risks. So control risk are risks that are still present after an entity takes action to address its inherent risks. That's a very simple definition, but pretty straightforward. So any risks that are remaining after the controls have been implemented. So an example of this would be like Cap Corporation having an inadequate supervision and review over petty cash transactions. So somebody has got custody of this, but nobody is actually reviewing what the work being done in that area is. Then finally, we have detection risk. Okay. And detection risk, remember, that's the auditor's responsibility, the work that they perform. They need to do sufficient work to make sure that risk is reduced to a minimal level to eliminate the possibility that material misstatements may still exist. So detection risk is characterized as any risk remaining after planned audit procedures. So an example of this might be an engagement team for Rosen Incorporated not performing confirmations testing over Rosen's receivables, and as a result, the auditor failed to identify a material misstatement in accounts receivable. So they should have performed a certain task, they did not, and as a result, a material misstatement was still present because they did not detect it as a result of their procedures. So yeah, the four components, again, I expect you to have knowledge of those to some degree, but the nature of those is really, really important and critical to get into. So let's move on to the next question. So it's mostly been said, and this is by me, that audit failure is a function of the auditor's inadequate assessment and/or response to an audit client's risk. Provide an argument support its statement and then provide an argument against this statement. Now, the argument for, I think, is pretty easy. I think this is not too difficult. So given that audit failure is usually characterized by a material misstatement on the financial statements, the audit risk model defines the methods by which misstatements occur. It is intuitively sensible to say that audit failure is subject to the rigor and application of audit risk principles. So if we apply appropriate audit risk procedures and make sure that we have adapted properly to any risks that we identify, then it's going to minimize the chance of failure in an audit. That being said, if we do not do that, if we do not properly allocate for risk, then that's where the misstatements may occur. And the example is kind of the same thing that we talked about in detection risk. We did not instigate proper confirmations testing in a certain area, and as a result, a material misstatement occurred. So it's pretty obvious that there's a link there between the audit failure and the material misstatement, and there's a link between audit risk and material misstatement. So the link there is pretty apparent, and it's going to be something that we would hold together when we think about the nature of audit risk and the nature of audit failures. Now, against this is a little bit more subtle. It's a little bit more distinct. So keep in mind that when we talk about audit, we tend to use this term called reasonable assurance. Now, the idea of reasonable assurance is that we could actually still have a material misstatement in the financials, even if we do our job as properly as we should. The idea being is that we cannot provide absolute guarantees of any type of performance. We can only do work to a certain extent and then hope that our work is sufficient to be able to identify all relevant material misstatements. So there have been in history, there have been audits that have taken place that were done well, performed well, and yet material misstatements still existed. So it's possible that we could have an audit failure, even if the auditor adapts properly to the risks of the audit risks and the risks within the audit risk framework. So they address audit risk, inherent risk, control risk, and detection risk all properly, but the material misstatement will still occur. Now, again, that's a little bit less obvious, a little bit less apparent, but it's still important to note that that failures can still occur even due to the best work performed by the auditor. All right. So question number 5 goes into detail about the Wirecard scandal, and I had you look at some resources of this. We're not going to delve too deep in the Wirecard scandal because we've got a little bit more to get into, but I want you to think about the audit failure related there. And does this event support the notion that audit failure is a function of auditor assessment and/or response to client risk? And why or why not? What is the reasoning for your answer? I think this one is pretty much a strong evidence for support of the notion. And part of this has to do with the fact that EY was presumably negligent in its audit of Wirecard. One of the most obvious examples of this had to do with the respect to the confirmation of Wirecard's cash balances at OCBC Bank. If you remember in the article, they talked a little bit about this, and they could not get direct confirmations from the bank. I think the logic and the argument behind that was it was not possible to communicate directly given governmental restrictions that were in place. So they had to operate through a third party. Little did they know that that third party was being kind of fraudulently manipulated by a Wirecard, and the information they were receiving was completely and totally fictitious. So yeah, not addressing the proper risks when they say that these are confirmations that we can't get directly from the third party. We need to be able to adapt to that to be able to make sure that we address the risks that are present in that situation. They did not really take that seriously. As a result, cash was overstated by about $1 billion, and that's one of the big keys to the scandal that led to their profit manipulation. All right, so moving on. I want you to look at the sparked intuition power case. And so the very first thing I had you do is to prepare a list of risk presence at sparked intuition power. So you should have already done this. And basically the idea is I wanted you to have the list of risks that we could look at here. So we're going to go ahead and go into a little bit of depth and detail on this. So presumably by now you've submitted the first part of the assignment and you've got access to the document that I'm about to show you. So if you've not actually opened this document, you'll want to go on to Brightspace under the Week 3 tab, and you'll want to actually be able to open this document so we can take a look and talk through it together. So one of the things that we're going to be talking about are what are the risks present. And so there's basically a list of 10 risks that have been identified over the course of the engagement. Now, these may or may not align with the risks that you identified, but that's okay. We're going to use this list for our remaining tasks. So let's go ahead and talk a little bit about the nature of these risks. Now, as we're going through these, you may want to make some notes on some of the things that I share with you, because you will need to actually have this information for your assessment that's going to take part in the second part. So let's go ahead and go through the identified risks. First risk is that SIP has exceeded earnings expectations for the past 16 quarters. Now ask yourself, if you were doing an audit on a client and you noted a client had 4 years of exceeding earnings expectations, would you consider that to be a regular occurrence? And the answer is this is pretty infrequent, okay? And this is also something that aligns pretty closely with the solar buyback program that they had in their that they'd created that started 5 years previously. So there's a lot of alignment between earnings expectations and the solar buyback program, which could be a signal and indicator that something we need to investigate further. Secondly, multiple SIP offices have had outdated technology and are still on paper-based systems. All right, so it's the second risk that we identified here. So how effective do you think reporting is going to take place if there's going to be $17 billion in revenue, $17.63 billion in revenue if they're using outdated technology? That's something we want to consider, is that do we believe that they could do accurate reporting at that level of technology being outdated? All right, third question. Accounting procedures have remained the same for the past 15 years. Now, this is an interesting one, especially with the technology flourishing in the past few decades. There's been continuous change in procedures and regulations for the accounting industry, and there's been technological evolution. So the fact that the procedures are made the same may be a little bit of a problem for us to address. Fourth, the solar buyback program after 5 years has annual revenues of $950 million. It's important to note that when you integrate new programs into organizations, oftentimes they operate at a loss for the immediate future, and then they don't really generate profits until some time later. The fact that this has been so successful immediately is something that we want to investigate a little bit further, at least keep our eye on as auditors. Risk number 5. Uh, the solar buyback program has an advanced revenue recognition system. And so the fact that they recognize the full amount of first year revenue, is that in accordance with GAAP? Is that yes or no? And as we know from Enron, the answer is no, that is not a GAAP and is no longer in accordance with GAAP. It used to be back in 2002, but then they recognized their folly with that. So recognizing first year revenue in advance, that's not in accordance with GAAP. So that may be something that we have to think about with respect to risks. Risk number 6, the use of a small local bank for the solar buyback program. It's going to be very difficult for small local banks to be able to operate at the same level of technological efficiency and reporting efficiency as a larger bank, particularly if they're operating using millions of dollars on an annual basis through the organization. So something we have to consider as well. All right, risk number 7, their bank does not have the capability to complete online confirmations, and the previous external auditor relied on SIP to submit bank information. Third-party confirmations they do provide assurance over accounting balances, and SIP providing documents on behalf of the bank, that's not a normal process. So the fact that our audit client is actually getting involved in the confirmation process, that seems to be a real problem, something we need to address. All right, risk number 8. The previous chief operating officer and chief financial officer both stepped down 7 years ago. So this is a while back and it's our window, but something we need to keep in mind that we have to think about, because that changes in executives in an organization do have impacts even many years in the future. So when multiple executive board members step down for their position simultaneously, it does raise questions. Now, there is a question of whether or not 7 years ago is still going to be relevant today, but that's something that we're going to include in our risk analysis. Risk number 9, SIP utilizes performance-based compensation bonuses for its executives. So when a company uses performance-based compensation structure, when that continuously does well, it will raise red flags. Keep in mind, this represents a pressure for organizational executives to actually provide certain results and to make those results achievable and consistent. But companies generally tend to be transparent about their compensation structure. So the question is that even if it's a risk, the transparency does mitigate that to some degree. So what is their according risk level? Our final risk is that the solar buyback program was implemented by the new COO and the CFO. And so new executives generally try to implement new innovative program after taking positions. And the buybacks program rapid success may be a core point of concern with the new executive team. So we do have some concerns in this area, but we have to ask, is this something that we want to continue on forward and investigate? It does represent a risk, but to what degree? What level do we identify those risks at? So why did we go through all of that? And the answer is that you have a second part to the case that you will need to complete. And you will notice that there's a time test or testing timesheet here, and it has to do with some information that you will have to enter. For each of the risks that I provided to you in this timesheet that, again, is on Brightspace, you should be able to access it by now, you are going to have to assign a risk level of either low, moderate, or high, and then you're going to have to assign a number of hours to be dedicated to that. Now, this next part is not particularly difficult. Keep in mind that it gives you some guidelines of how to assign the hours. So a low risk level will generally involve 2 hours of work, 1 hour preliminary plus one additional hour. Moderate is 3 hours and high is 4 hours. So why is this important? Why don't just assign everything as high so that you have make all your bases covered? Well, the answer is you only have 35 work hours in this area that you can allocate to this particular project. So a maximum of 35 hours is less the number of hours based on risk. Okay. So what we need to do is we need to make sure that we do use no more than 35. If possible, we would like to use a minimal amount. We would like to use less than 35 because that means that we have savings that we can allocate to other areas. That being said, there is a trade-off between the amount of work that we perform and the amount of risks that we incur. So if we allocate something as being a low risk that is in fact a high risk, that is going to require additional work later on, and it may incur additional risks that we're not foreseeing. So your task in this is to be able to use as much of that 35 hours as you think is necessary, but to be able to save when possible and to try to avoid allocating too low a risk to a particular area that's going to be a much higher risk area. So what I'd like for you to do is I'd like for you to pause the recording, and I'd like for you to assign your risk levels and your hour assignment. And keep in mind your hour assignment does need to be less than 35, okay? An optimal assignment should actually be significantly less than 35 hours. I'm not going to give you that number. I'm not going to give you that allocation, but you can actually do this in under 30 hours if you do this properly. I would be very, very cautious about the assignment because what you may find is it's not immediately obvious to identify what the relevant risk level. So if necessary, opt for more rather than less risk in that particular case. We'll come back once you've done the assignment of the risk levels. Okay, so we're back. And before we get started, I want to make sure that we clarify what's going on here. So this is basically an assignment of risk. This is extremely subjective. I seriously doubt that you're going to come up with the same answers that I'm about to give you, and that is fine. Even if I were to identify partners in practice who've been doing this for 20 years, they probably would come up with different answers than what I come up with. And so it's not necessary that we get the correct answers this time, but that we can articulate the rationale behind that. So let's go ahead and look through each of our risks. So exceeding of earnings expectations the past 16 quarters, that's unusual, but it's not an overtly problematic risk. I would definitely assign a moderate level of risk. So we're going to assign 3 work hours to that. Then outdated technology, that one's on the cusp. I would say that this is somewhere between moderate and high, but opting for it, I think I'm going to go with moderate simply because we do identify this as a risk that needs to be addressed so we can adapt our procedures accordingly. So again, a moderate and 3. Risk number 3, the accounting procedures remaining the same. I hate to sound like a broken record, but I think we're going to set this one at moderate as well because accounting procedures do need to be updated, but it's not something that we can't adapt to or we can't actually address as the audit team. We do know that if the accounting procedures remain the same, that we need to be able to account for that in our audit procedures. So this is going to be moderate as well. The solar buyback program, generating revenues. This is something that I'm a little bit uncertain about. I think this could be somewhere in the low area, but given the fact that it's something that has generated a large amount of revenues in a short amount of time, I think I'm going to give it at least some risk. So we're going to assign moderate to that. So moderate for our first 4 risks, which again, this is pretty easy if we're just going to assign moderate to everything, but don't get too ahead of yourself because we do have a few that we need to talk about that are not moderate. One of them is going to be this next one, Advanced Revenue Recognition System. This is something that historically has been problematic for many organizations. If they try to do things that are outside of the scope of additional or of generally accepted accounting principles, or outside of the scope of just traditional accounting reporting, they create a lot of problems. So this one's going to be one where we're going to set risk level at high, and for obvious reasons, because we don't want another Enron. All right. Risk number six, use of a small bank for the buyback program. So the small bank itself is not as big a problem as you might think. We would like to have a larger bank that is going to create risks there, but it's still only a moderate risk as long as we're able to address the problem. But related to that is going to be risk number seven, okay? Risk number seven is that they cannot complete online confirmations, and they use third party, the auditors relied on a third party, or not, they're not being able to get from the third party. They relied on SIP for that. Having the client involved in the confirmation process is a big no-no in auditing. We know that the auditors may actually end up getting information that's been manipulated by the client. That was, in fact, what happened with the Wirecard fraud, and that's one of the reasons that this was motivated by that particular fraud or that scandal. This is a high risk. This is something we're definitely going to set up 4 hours for research on, and there's going to be according audit procedures associated with that. All right. Going in the opposite direction, we've got a couple of items here that we need to talk about that are going to be low risk. So the previous COO and CFO stepped down 7 years ago. That was a long time ago. It's probably not relevant right now. So this is going to be a low risk. Is it still relevant? Yes, we want to answer the questions for them stepping down, but it's not going to have a big impact on the current year financials. And also SIP utilizing performance-based compensation. Again, this could be an impetus for fraud. It could definitely represent a pressure, but the transparency associated with most executive compensation, it is reported in the financial statements. The transparency is going to mitigate type of risks that we would experience here. So we're going to say that that's low as well. Finally, we've got number 10, the solar buyback program is implemented by the COO and CFO. As long as there's transparency surrounding that, and we do know that there is because that's a big program that we have identified, then the innovation that's going to take place around these programs is not necessarily going to implement a risk. The revenue recognition that follows may represent a risk, but the programs themselves, not really. So this is another low item. So if you followed the procedures and basically said moderate for the first four, then you said high for number five, moderate for number six, high for number seven, and then low for the remaining three, you came up with 29 work hours. Now, what happens if you misassigned something? So let's just say you signed too high a risk. Generally speaking, that's not a big problem because that just means that you used a little bit of extra time in an area you didn't need to. But what happens if you assign too low a risk? Let's say that you looked at the confirmations and you said, we don't need to focus as much time on that and that assessment. That is where things can run afoul because that's where we think that problems can arise if there's not enough focus by the auditor or the audit team on a particular area. They may not devote sufficient procedures or sufficient timing in their work to be able to address problems in that area. So the fact that online confirmations are not being processed and they have to rely on the client to be able to receive the confirmations, that is something I'd want to address immediately, and I want to devote substantial time. This is anything less than a high would be a disservice to that particular area. So you'd want to make sure that you identify the really, really high risks and focus on those pretty heavily. Putting less time in that area, we're going to increase our risk of material misstatement to a greater degree. All right, so hopefully you got a little bit out of this activity. It was a little bit confusing, a little bit challenging simply because of the subjective nature, but I do think it's a valuable exercise to walk through to make sure you understand the nature of audit risk within the context of a financial statement audit.